Hey traders, Raghee here, and in this recap video, the question is, how tight do you want to trail your stops? We're going to use the NQ trade from Friday. I walked you through the management techniques that I used yesterday, and today we're going to talk about what's happened as the NAS starts to slow down. So I could take you sequentially through this trade, and the tactics that I'm going to teach you, you can use again and again and again. It's just a process that you need to know. And so we're going to start off with an understanding of the price movement range for the contract. So I'm going to go grab that for those of you that didn't see this video recap yesterday. And the hourly is the 20 to 26. And what I wanted was the market to have, as it was trending higher, at least 20 to 26 from current price levels to the bottom line of the wave, which is the 34 period exponential moving average on the low. That's the red line. So we basically narrowed it down to the 30 or 60 minute, and the 60 actually was a little bit more cushion than we actually needed. It was closer to almost 2x the hourly PMR, while the 30 minute was just 1x the hourly PMR. So at some point, while we don't talk about dollars or percentages, at some point dollars does become relevant, because for a lot of traders, they're going to want to know, all right, well, if the market's trading around, 59.45, and on the 30-minute time frame, you're telling me I need to be down around really no closer than around 59, 15, that area, what is the amount I'm risking on unrealized profit? Again, from 59.45 to 59.15, that's $600 per contract. So some of you might say, okay, that's really all I want to risk. But let's also remember that we are long, okay? We were long from 58.05, talking about 59.45. It was a $2,200 move for the NQ, okay? Now, remember one thing as it pertains to the NQ, the NASDAQ, is your maintenance on this would not have been that day trading, say 500 you might get from, say, TradeStation or Infinity. Once you take this thing overnight, you're talking about $4,200, almost $4,300 initial margin. So a lot of you might say, oh, okay, once I get past that 4:15, 4 o'clock, 4:15 time, I'm forgetting the cutoff. But once you get past that cutoff, you need the full margin. If you're going to use the day trading margin, you've got to be out. So that might be a determining factor. So keep that in mind as well. So I want to get really strategic with you here in this video so we get pretty specific to the kind of margin requirement you might need, to an additional reason. You might just hit the eject button based upon time, saying to yourself, well, I don't want to take this overnight because my margin requirements completely shift, and dramatically. So that's another consideration. Now, if you take this same conversation over to the 60, right, and I said it was 2x, so we were talking about the market up at, again, 59.45, and now we were talking nearly to 58, say 95, about 50 pips, right? Now, what are we talking about? Again, if you were in this market, now you're talking about $1,000 of unrealized profit. 1,000 of, again, in from 58.05, all right? And if you lock in 58.95, you're actually locking in $1,800. So if you got in at the 58.05 breakout we took, and you're going to back off by 2 hourly price movement ranges, be aware that from a unrealized profit up at 59.45 of roughly, in this case, $2,800, now you're risking 1,000 of that for your trailing stop. And these are the kind of considerations that, realize these numbers aren't arbitrary. They're based upon this information here. So go ahead and write down 20 to 26 in the upper end of the hourly price movement range for the NASDAQ, because this is going to affect the way you trade the open. This is going to be the way you would trail a stop in a trend. This would even be the way you would gauge how wide a choppy intraday market is for traders who focus on choppy market consolidation into squeeze triggers, into momentum plays through ceilings or floors. So tomorrow I'm going to walk you through an intraday setup on this one, but today I know we got into some arithmetic here like it's third grade, but I really want you to think about how those hourly price movement ranges transition into actual dollar amounts and the difference between using the 30-minute and protecting a lot of your upside versus the 60. Now, what's the punchline? You're still in the 60-minute time frame. So you might say, well, if I want to give the market a little bit more latitude and all I'm doing is risking unrealized profit, and you're comfortable with that 50 points, you're comfortable with $1,000 per contract, but you want to stay long, then that is absolutely a level that you're comfortable with, because right now you could take this into the Asian session as an open trade with a trailing stop on the other side of the 5,900 major cycle level. So you might have to watch this video a couple times to see how we used these numbers. These are not arbitrary numbers. These are historically relevant numbers. These don't change from day to day. They change very subtly, and they're changed by volatility and price movement ranges. So ultimately, if you have that 20 to 26, you can use that in a number of ways. I hope you do, and I'll see you in the next update.